Economic crises. They make headlines, shake confidence, and hit the everyday person where it hurts the most, their wallet. Jobs disappear, savings shrink, and bills pile up. But here's the thing. While millions are struggling, some people are not just surviving, they're thriving. In fact, history shows that the rich often get richer during economic downturns. Sounds unfair, right? But there's a clear, almost scientific reason behind it, and today, we're breaking it down. Hi everyone, welcome back to the channel. If you've ever wondered why financial crises seem to hurt the middle class but the wealthiest keep climbing, you're about to get the macroeconomic logic explained, simply without the jargon. Let's start with the first key reason: liquidity and access to capital. Think of liquidity as cash in hand, or assets that can easily be converted into cash. During a crisis, most people's savings are thin, debts pile up, and banks tighten lending. But the rich, they have cash, investments, and credit lines ready to go. When markets dip or businesses struggle, these are the exact resources that allow the wealthy to buy low and secure high-value assets at a fraction of their normal price. For example, during the 2008 financial crisis, stocks plummeted. Many ordinary investors panicked and sold at losses. Meanwhile, billionaires like Warren Buffett used the opportunity to buy major stakes in companies at bargain prices. That move alone positioned them for massive gains once the market recovered. The second major reason: asset ownership. The rich typically hold assets, stocks, bonds, real estate, businesses, that aren't tied to day-to-day income. During a downturn, these assets may temporarily lose value, but they are still fundamentally valuable. Ordinary workers rely on wages, which can vanish quickly. The rich, on the other hand, can wait, leverage, or reinvest. This time horizon is critical. Take real estate, for instance. During recessions, property prices often dip. Many middle-class families panic and hold off on purchases. The wealthy? They see opportunity. Buying distressed properties at low prices, renovating or holding them until the market rebounds, multiplies their wealth long-term. This isn't luck, it's strategy powered by patience and capital. Another factor that makes a huge difference: access to exclusive opportunities. Not all investments are available to everyone. Many high-return assets, private equity, hedge funds, or certain corporate bonds, require substantial capital to enter. In times of crisis, these assets often become cheaper or more lucrative. Ordinary people simply can't compete at this level. So, the rich get first pick, increasing their wealth while the majority struggles to make ends meet. Cut to host speaking to camera. And it's not just about buying ass poppets. The wealthy can influence deals, have teams of financial advisors, and even government connections that allow them to protect and grow their wealth. During crises, that kind of access turns into a massive advantage. Now, let's talk debt strategy. It may sound counterintuitive, but economic downturns often make borrowing cheaper. Interest rates usually fall as central banks try to stimulate the economy. This is where the rich excel. They can take on strategic debt to buy assets, knowing that low interest rates amplify returns when the economy recovers. Meanwhile, ordinary families may already be drowning in consumer debt, credit cards, mortgages, personal loans, and are forced to cut spending. They can't leverage low interest rates in the same way. In short, crises create a playground for those who already have resources, while limiting those who don't. Lastly, let's address behavioral economics. The rich often see crises differently. While fear drives many to sell and hoard, successful investors see opportunity. They're trained to think long-term and ignore short-term panic. This mindset difference isn't just psychological. It has a measurable impact on wealth accumulation. Think of it this way. During chaos, if everyone else is running to the exits, those who calmly enter the room first get the best deals. It's almost a law of economics. Risk, patience, and timing become wealth multipliers, especially when others are too scared to act. So when we connect all these dots, liquidity, asset ownership, exclusive access, strategic debt, and behavioral advantage, we start to see a clear pattern. Crises don't just redistribute wealth randomly. They amplify existing inequalities. The rich have tools, strategy, and patience that turn downturns into opportunities, while ordinary people face short-term shocks they can't easily overcome. And here's the kicker: this pattern repeats itself across time and continents. From the Great Depression to the 2008 financial meltdown, and even during the COVID-19 crisis, the ultra-wealthy often emerge stronger than before. It's not magic, it's macroeconomics in action. Now that we understand the macro logic behind why the rich get richer during crises, let's look at real-world examples that make this crystal clear. History isn't kind to randomness, it favors strategy and foresight. Take the 2008 financial meltdown. Millions lost jobs, homes, and savings. Yet some of the wealthiest individuals saw it as a buying opportunity. Warren Buffett, known as the Oracle of Omaha, invested billions in companies like Goldman Sachs and General Electric at rock-bottom prices. By the time markets recovered, these investments had generated enormous returns, further solidifying his wealth. Meanwhile, everyday families were still digging themselves out of mortgage crises and debt. Notice the pattern. Access to capital plus calm decision-making during panic equals long-term gains. The rich aren't just lucky, they're prepared. Real estate is another prime example. During recessions, property values often drop sharply. Most middle-class buyers hesitate, fearing further losses. But wealthy investors swoop in. During the COVID-19 pandemic, luxury property investors bought distressed real estate in major cities worldwide. Within months or years, those same properties appreciated, creating wealth that the average worker could only dream of. It's a cycle repeated time and again. The rich buy low when everyone else is selling out of fear. Crises also make corporate acquisitions cheaper. Companies struggling during downturns are more likely to sell assets, or even the entire business. The wealthy, with both capital and strategic insight, are ready to take advantage. Jeff Bezos, Elon Musk, and other tech magnates have expanded during economic uncertainty, buying companies or investing in technology that would have been far more expensive in normal times. By positioning themselves during these windows, they multiply their influence and wealth, while others are focused on survival. And it's not just about money. During crises, policy and government support often indirectly favors the wealthy. Large corporations and wealthy investors have access to lobbyists, advisors, and special programs. Tax incentives, bailouts, and subsidies tend to flow toward those who already have substantial stakes in the system. The everyday person rarely benefits at the same level. This structural advantage ensures the rich continue growing their wealth even when ordinary citizens face stagnation or loss. Here's a truth that might sting. Economic crises amplify existing inequalities. But understanding this isn't just about cynicism, it's empowering. By seeing how the system works, anyone can learn to protect themselves financially, even if they can't buy a $100 million company. So what can everyday people take away? First, cash is king. Having liquidity allows you to weather short-term shocks without panic. Second, invest wisely, not impulsively. You don't need billions to start. Small, consistent investments can grow over time. Third, learn from crises rather than fear them. Observe patterns, recognize opportunities, and prepare for the next downturn. Wealth isn't only about money, it's about timing, knowledge, and strategic patience. To recap, during economic crises, the rich get richer because they have access to liquidity, control over valuable assets, strategic use of debt, exclusive investment opportunities, and a mindset that embraces risk differently than the majority. Ordinary people often get caught in short-term panic, lack access to high-yield assets, and struggle with immediate financial pressures. It's not conspiracy. It's the natural outcome of the system and its rules. So next time headlines scream about the market crash or economic doom, remember, while fear drives the masses, preparation, strategy, and patience create opportunity. That's the invisible lever that separates those who survive from those who thrive. Economic crises aren't just periods of loss. They are periods of learning, strategy, and opportunity. The rich getting richer isn't an accident. It's a result of choices, preparation, and understanding how money moves when chaos hits. And the good news? Anyone willing to learn, adapt, and act can start building their own financial resilience today. If you found this video insightful, hit that like button, share it with someone who needs to understand the game, and subscribe for more deep dives into finance, history, and how money really works in the real world. Remember, knowledge is the first step to wealth. Thanks for watching, and we'll see you in the next one.